viewers, you are welcome back to Lab Premium Educational Consult. Today we are taking on to another section, break-even analysis and the business mathematics. So that's what we are going to do today. So if you are new on this channel, kindly make sure to subscribe to this channel, like and share our videos to as many students as possible that we can reach and serve every student who's having difficulties in understanding certain courses in business mathematics and other math concepts. So thank you. So let's zoom to ready for today's activity. So we are taking on to break-even analysis. So before we continue, what is break-even analysis? We are saying that break-even analysis has to do with one of the marginal costing principle, which talks about the relationship between your cost, revenue, and what output. It's established relationship between cost, revenue, and what output through marginal costing principle, and we'll be exposed to that marginal costing principle as we move along. Alright, so we are going to talk about cost, revenue, and what output. So that's break even. Now we are trying to talk about the relationship between your cost, your revenue, and output. So if I should have this graph will have y, then I have what x. The y represents as cost or your revenue line, can also be called revenue line. Then this one, we call this your output or in units, and this is your actual revenue line. This is actual revenue line. Okay, all right. So how does this item or variable also relates to break-even analysis? So what is cost? We are saying that cost is basically any amount of expenditure incurred on activity or a process, right? So let's say you went to a supermarket to buy oranges, or let's say fruits. At the end of the day, you pay something to the seller or the vendor who is selling the orange to you. That money that you pay to that seller or the vendor who sold actually the orange to you, it's a cost, right? It's a money that you're going to pay to the person, so that becomes what? A cost. So you can clearly see that always when there is a cost, there is an exchange of what we call benefit. One gives benefit to in exchange for what? Another. So that's what I mean by what? Cost. Then revenue, talking about revenue, you're talking about what? Incomes that arise in the normal activities of the business or ordinary activities of what? The business. So let's say we are into business selling what? Pure water to customers or people. At the end of the day, we're able to sell, let's say, 100 sacks of pure water. What happens here that once we sold these goods or these units of water, you're going to get what? Money. The money that you're going to get is what we call what? Revenue, because that's our actual activity that we actually engage on. So that's what we mean by what? Revenue. Then output is based on the example that I said, the 100 that we sold is basically the output. I hope that is clear. So that is the output. We are talking about the number of units to be produced or what? Sold. That is what? An output. So all these things talk about break-even analysis. So in time there's break-even analysis, we are into cost, revenue, and what? Output. Where cost, revenue, and output are into relation, then they influence or interplay with what? And one another. So that's what I mean by what? Break-even analysis. So in a more generic or in simple terms, we are saying that break-even can be defined as the minimum level of sales revenue or units of goods that an organization must meet or produce to cover all its costs. Okay, the minimum number of what? Or level of sales revenue or units of goods that an organization must meet to cover or to produce in order to cover all its costs. So at the end of the day, we are saying that if I have the total cost for the organization to be TC and they are producing, I'm saying that with the break-even, once the total cost is known, once it's break-even, you're neither going to make either a profit or what? A loss. So at that point, your total cost should be equal to what? Your total revenue. So all the output the organization will produce and sold to cover all its costs. Once it cover all its costs, meaning that there wasn't any profit made right? Or losses what incurred. So on that aspect, your total revenue, which is this TR, will be equal to your total what cost, and that's what I mean by what break even. All right. So how do you also determine the cost that went into what we call the production of the goods or the units that you actually sold to your customers? How do you determine the cost, and what are the factors that are necessary in determination of what that cost? So these are the factors that we're talking about. Factors like labor, your workers that you employ there when it comes to the production activity, those who actually engage on the turning of the raw materials into finished goods, your labor, how much did you pay to them? It's one way of knowing the cost. We talk about your material, the material that you used, the raw material that you used to start with the production of the unit or the goods. You also need to know the total cost that you incurred for that, so that you can also determine the total cost for the organization. Then also the capital, the amount of money you used to start in the production of such units. Let's say pure water. What was the cost of the capital? You need to be able to tell us so that we can easily. Then you being the entrepreneur, you came out with the business. You need to pay yourself as a going concern, as a business. You need to pay yourself. And normal, you need to pay yourself. You also need to know the cost that you also incur in the running of the organization. So when these four items are into play, then we can know the total, and we can also know the total cost of these four items. Then we can say that we can accurately determine what the total cost for such unit that we sold or produce or sold at the end of the day. So at that point, once you're able to determine the cost of labor, material, and capital and entrepreneur, we can say that is the cost of what production. And at a break-even point, or at a break-even, your total cost should be equivalent to your total. So where you're able to calculate the total cost accurately, then your total cost for the production of such unit will be equivalent to your total revenue. That is the amount of money that you obtain from the selling of such goods to your customers. So that's what I mean by that aspect that you need to talk about. Then we move on talking about objectives of break-even. What are the objectives of break-even? You are engaging on to analyze cost, revenue, and output. What is the aim? What are the aims that we need to understand when it comes to break-even analysis? So we are saying that break-even analysis, the objective and the break-even analysis is to find the level of output at which your cost equals your revenue. And that's why we said here that at the break-even, you neither make profit nor loss. So at that point, your total revenue is equal to your total cost. So that is the objective of any organization, to know the point at which they are break-even, to know that there wasn't any losses incurred or profit was made. And if that is so, it is good. It will be better not to make profit than to make losses. So if you break even, you neither make any profit nor make any loss, then it is what? Good. At least you are able to control cost. And that's one thing that break even help us to analyze on. So that is the objective, to find the level of output. That is the output at which your total cost equals your total cost equals your total revenue, or total revenue equals your total cost. So that is the objective of break-even analysis. All right. So with the cost here, we have various types of costs. We are going to break this cost into two components per our discussion. We are going to break it into what? Two, which is fixed and your variable cost. Fixed and your variable cost. I hope that's okay. So when we're talking about, so we're saying that for you to determine your total cost is equal to your total fixed cost, your total fixed cost plus your total variable cost. So anytime you add your total fixed cost plus your total variable cost, you are getting total cost for the organization. But what are the meaning behind these costs that we are talking about? What is total fixed cost? This one. We are saying that fixed cost is a cost irrespective of whether we are producing or not, you incur. Whether you produce or not, you're going to incur. So on that aspect, we are saying that the nature of fixed cost, it doesn't change. It remains the same whether you produce or you don't. For example, when it comes to electricity, let's say you are an organization that produces, let's say, toffees. You use light to together with your machine to produce the toffees. At the end of the day, if you don't produce, you're going to pay what? Electricity for your activity, because your administration is going to use what? Electricity to engage on the activity, though the main activity here is what? Production of toffees, which will help you to generate more revenue. But at one particular point, you're not producing. Yes, you need to pay for electricity. Then also an item like rent. You have hired, let's say, a warehouse where you keep your item that you produce in. I know they didn't produce. The house is there, or that place, the premises is there. And then they're going to pay what? The one that you hired from. So these are what we mean by what? The total fixed cost here. Such cost doesn't change with the level of activity or output. So that's what we mean by total fixed cost. Then your total variable cost is an opposite to the total fixed cost. We are saying that with the total variable cost, here the cost will change with respect to what? Your output. The cost will change with respect to whether you produce or not to change. That's what I mean by what? Your total variable cost. Okay, so total variable cost like material, direct material, labor, and so on and so forth. So when there is a change in, let's say, at first, let's say labor was having a capacity to produce, let's say, 100 units of toffees. But now, their capacity have changed. Now they're able to produce what? 110 what? Toffees. What is happening here is that maybe probably can reduce it that their skill level has changed, they have advanced, and therefore they are producing. So you realize that the amount of money that we pay to labor on the basis of 100 units they produce wouldn't be the same as that of what the 110 that they produced. Now they are currently what? Producing. Because I hope you are getting what I'm trying to say. Yes, because all things being equal, 100 units, the cost going to pay for labor for 100 units will be lesser than that of what? 110. And on that, when it happens like that, we are saying that labor cost has what? Changed, because labor becomes what? A variable what? Cost, in which it will respond to the level of changes in activity or the output of what? That organization, and the product in which they are actually what? Producing. So that's variable cost. It's a cost that responds to changes with the level of output or what? Sales. That's variable cost. Then revenue, you have defined revenue already. You say revenue is basically any amount that you obtain from the ordinary cost of activities of what? The business. So that's what I mean by what? Revenue. So the rest will be commentaries. I need to get it done. I hope you are getting everything clear. So let's look at an aspect of break-even analysis, and we are going to look at assumptions under break-even analysis. Assumptions underlying break-even analysis. Assumptions underlying break-even analysis. So we are going to look at the assumptions underlying break-even analysis. So we are saying that one of the assumptions under break-even analysis is that your total cost can be separated into fixed and variable cost components. And it's true. We said that total cost is equal to what? Total fixed cost plus total what? Variable cost. That's one of the underlying assumptions. That under break-even analysis, you can separate your cost into what? Fixed and what? Variable cost what? Component. And that's one assumption. Then also, your variable cost per unit remains constant, whilst your total variable cost varies in direct proportion to your volume of what? Output. So we are saying that first, your total cost can be separated into what? Total fixed cost plus total what? Variable cost. Then also the second one, your variable cost per unit. Your variable cost per unit. Your variable cost per unit. Your variable cost per unit remains what? Remains constant. But your total variable cost will what? Varies. That's what the assumption is saying. And what is the meaning behind this what? Assumption that we are talking about? So now we know that your total variable cost will have this straight line. So assuming that we have this output, your total variable cost, then your total, that's unit variable cost at this sign as Ghana shilling. Then you have output 100, 200, 300, and 400. You have total variable cost to be 1,000, 2,000, 3,000, 4,000, and others there. We said that your variable cost, we said variable cost is a cost that changes to the level of what output or activity. So you can see that if you have 100 outputs of units, the cost will be 1,000. What about 200? We said the cost are going to be incurred on producing that of the 100 wouldn't be the same as that of the 200. It will change. That's why you have here to be 2,000. So the assumption here is telling us that you are saying that total variable cost, your total variable cost changes by your unit variable cost. That's variable cost per unit what remains what the same or is constant. That's one of the assumptions. So let's see. I have 100. I'm having an output of what 1,000. I have 200. I'm having an output of what 2,000. 300. I have an output of what 3,000. 400. I'm having an output of what 4,000. What about how do you find unit variable cost? So unit variable cost can be found per each activity level with respect to the total variable cost. So if I divide 1,000 by 100, I'm going to get 10. If I divide 2,000 by 200, I'm going to get 10. If I divide 3,000 by what 300, I'm going to get 10. If I divide 4,000 by 4, I'm going to get what 10. So that's why the assumption is trying to tell us that anytime under break-even analysis is an assumption, your unit variable cost remains constant, but your total variable cost what changes with respect to the output level of sales. So that's another assumption that you need to get it clear. So if you like, you plot this on a graph, you're going to have your if you plot this on the graph, you're going to have your something like this. Your total variable cost will be something like this. Total variable cost will be something like this. Let's say here is y, here is x. I'm using just presentation. Your total variable cost will be like this. Then your that of your unit variable cost also be like this. That's how it's gonna be. Okay, when you plot it. So you clearly see that here is constant, meaning that a straight line, but here it changes at the output change. If the output is here, the cost is this. If the output is here, the cost, so the cost change with respect to changes in output. But here the output, as output changes, it remains what the same. And that's the assumption, and that the variable cost per unit remain constant while total variable cost changes with the level of output or sale. Then you're also saying that under break-even analysis and an assumption, we will be able to know all the cost. We actually know all the cost based on what we discussed on an aspect of labor, material, capital, and other things. We're able to determine what the cost accurately, right? But most of the times, if you don't have proper records or proper documentation of how the cost will incur, it can be very difficult for you to get it. But that will be the limitation when it comes to break-even analysis. But you are talking about the assumption, right? Then also there is no time value of what? Money. When it comes to break-even analysis, there is no time value of money, because we are relying on the total cost, total revenue. We want to establish relationships, so we are not in to find whether the rate at which your money that you have it now, your cost that you have it now, will change in future. Okay, that's the time value of money, right? That your money or the value that you are having as at now, when you are to have it in, let's say, for a particular years, it will change. With break even, there's no time value of what? Money. So that's why you also need to talk about and other things that we need to discuss. Though we can't present it, but you can have an audio form. So let's continue with that. So we are saying that all that we have learning, talking about here and there, break even help managers, internal managers, to make what decisions. And what are some of the decisions that managers will engage on when it comes to break-even analysis? Managers will engage on with a lot of decisions when it comes to break-even analysis. What are some of the decisions that the manager will engage on to use break-even analysis to compute? Let's see. So with break-even, it helps managers to make decisions. What are some of the decisions that managers can make on the basis of break-even analysis? So managers can say that on the break-even, with the technique, break-even is a technique, right? One of the principles of costing technique, principle of marginal costing technique, right? So with a technique or as a tool that managers will use to make decisions, what are some of the decisions management can use break-even to, come it or bring it into effect? We can talk about how many units must be sold to break even, and break-even analysis will help us that if we are to sold or we are to produce or sold at this point or at this level, we can break even. There wouldn't be any losses or profit that will be what made. So that's one aspect. Then also, how many units must be sold to achieve what a target profit? There's what we call target profit. Target profit in the sense that at times managers might say that this is the level at which you want to achieve, so that we can, once we're able to achieve that level, then we can what make a profit. So if you fall below that, then you're not able to what achieve it. On that aspect, that doesn't mean that you're also making what losses. So with break-even analysis, help managers to make certain targets about the rate at which or the level at which they can what make profit. Though the analysis doesn't deem to what make profit or make any loss, but there is a certain level that if you exceed that level, you can make what profit. Okay, so with that, help managers to what target about which units must be sold in order to get that targeted what profit. Then also, how will profit and break-even volume be affected if fixed cost, variable cost, or total revenue increase or decrease? So when it comes to changes in these variables that we are talking about, your total fixed cost, your total variable cost, your revenue, if they are to increase or decrease, what will be the effect on your break-even in terms of your units and even in value? What will be? So these are the key decisions that break-even analysis help managers to do when it comes to break-even analysis. All right, so we'll end our decision making on break-even analysis as a part 1 of break-even. So we continue in a part 2 section where we're talking about key terminologies under break-even analysis, and we discuss formulas so that we continue to solve questions under break-even analysis. So thanks once again for watching this video. Please make sure to like and share and give comments. Recommend any comment that you think you don't get any concept, so that we can go through and what assist you to help you. So see you in the part 2 where we discuss the other aspects of key terminologies and the break-even analysis and the formulas involved in using to solve questions. So I'll see you in that video. Bye bye.